Good morning, everyone. Welcome back. Today, I will be analyzing Tesla. To analyze equities, I will use a 6-step valuation process, which consists of the steps shown on the slide. Additionally, the DCF model used for the price target will be available to download in the description down below. So what is Tesla? Tesla can be seen as a company with 4 main segments: transportation, energy, infrastructure, and AI/full self-driving. On the right, we can see the ecosystem of value creation that Tesla created, from the gigafactories going down to the different business segments, to the key element, data collection, that glues everything together, from software development, full self-driving development, and the creation and maintenance of the advanced manufacturing technique inside the gigafactories. For industry analysis, it is important to understand the different dynamics of the ICE vehicle market and the EV market. Currently, the legacy automakers are struggling from cannibalization, where the new low-margin EV products are replacing the profitable ICE sales, creating fundamental business flaws, blocking them from transitioning smoothly and winning the new race. This can be seen from the year-over-year growth table of car sales for the different brands, and you can see the struggle of legacy automakers compared to Tesla. Additionally, from the supply chain shortages and the current recession, the car market will get hit, with the lower margins and lower demand. As seen from the lower graph of cumulative EV sales after launch, it is clear that the best product wins, and currently, Tesla's products are winning. So where would you want to be positioned in this market? For competitive advantages, Tesla has a lot. The first is the economies of scale, especially in manufacturing. With the different versions of gigafactories coming online, we can clearly see the efficiency increases and the value that the machine that builds the machine gives to Tesla. Secondly, Tesla's brand in the electric vehicle market is equivalent of the Apple brand in the smartphone market, and the loyalty of the customers and the investors behind the company's mission is hard to find like Tesla's. Furthermore, Tesla's first mover advantage is crucial. The infrastructure from the supercharger stations, the fixed supply contracts for materials, and the corporate plans to set up for massive scale will give a ramp for Tesla to succeed in. Finally, all of Tesla's workforce is specific for the EV market, which is important as when legacy brands shift, there won't be enough good talent in the marketplace as Tesla has already hired the best, since the core technologies of ICE and EV vehicles are drastically different. A focus point for the competitive advantages is on the efficiency from version 1 of the Fremont Gigafactory and the latest version of the Austin Gigafactory. Here we can see 2 things. One is the massive increase in scale, and 2, that the Austin factory is built like a chip. It has everything built together in one big package, increasing efficiency and reducing costs. Tesla's CEO is Elon Musk, one of the greatest revolutionary entrepreneurs of our time. He has an amazing track record revolutionizing industries while maintaining high-level execution even throughout the business struggles. Over time, Tesla has created a lot of value for shareholders, almost 10xing since Tesla's inflection point in late 2018. And as Elon Musk is currently setting up Tesla for massive scale for the coming decade, shareholders will be rewarded as Musk keeps executing. The financial situation of Tesla is healthy. It has low debt with a debt-to-equity ratio of 0.14. It's having an aggressive PE ratio contraction from over 1,000 to sub 100 in a year. It has high enterprise value growth with an interest expense coverage of 44 times. It has high return on invested capital, high return on equity, which is good in a diminishing margin environment, all indicating a strong balance sheet. There are 7 main risks present in Tesla. The first is the macroeconomic environment, specifically inflation and recession, that will hit the car market as a whole, and Tesla will get impacted. Secondly, ramping production is the greatest challenge of any car manufacturer, and Tesla is no exception. The difference to other EV startups is that Tesla has proven to have done it before. Thirdly, with Elon's ambitious goals, supply side might not be ready to allow Tesla to reach the scale that they're aiming for. Fourthly, right now Tesla, it has a high growth pace, and if Tesla's growth were to slow down, multiples will crash and the stock will drop. Fifth, there are regulatory risks as the Chinese zero COVID rule, which heavily impacted Tesla's Q2 deliveries as the Shanghai factory got closed for weeks. Additionally, the German red tape delayed the launch of the Berlin Gigafactory for months. So, regulatory risks are and will be present in Tesla's story. Tesla stock has a beta of 2.13, so the volatility is significant. So if you're more of a risk-averse investor, which values stable, short-term movements, Tesla might not be the right stock for that specific reason. Finally, if Elon dies, it will be a hit to Tesla's culture as they will lose the visionary and the leader. Will survive without Elon, but will it thrive as much as without Elon? Highly unlikely. Before doing a deep dive in the DCF model, the price target gotten is 1,871. And as a reminder, if you want to try at different assumptions in the DCF model, you can get it in the description below. This is my Tesla DCF model going until 2030, and the output that I get from my assumptions are from a perpetuity approach 1,500 and an EBITDA approach 2,200, which creates an average of 1,871. And with the current price of 670, it creates an upside of around 180%. For the inputs and assumptions for the revenues and costs, I focused for Tesla on three main revenue sections: the automotive revenue, energy generation and storage, and full self-driving. On the energy generation and storage and full self-driving, I went more conservative as they're harder to predict correctly since Tesla still needs to scale them up to a significant portion of their percent revenue. For the year-over-year growth assumptions of revenues, for the total automotive revenue, we can see my year-over-year assumptions for the delivery estimates. And around 2027, I'm predicting around 10 million vehicles to be produced every single year from Tesla. And this is possible because of the compact model, which I think will arrive and ramped up around 2025. For the energy generation and storage, I extrapolated the previous years, and as the supply chain shortages ease up, the growth rate should pick up, aiming for the 3 terawatt target potential, which with these assumptions, it will not reach, so it is conservative. For the full self-driving assumptions, these were more difficult to predict, but I upped the internal uptake for Tesla owners of 35%, and considering that they will solve a full self-driving, 35% is conservative. And around 2025, I'm predicting that they will start leasing the software when they will have proof of concept that the full self-driving software works. And for the monthly subscription price, I did not give any premiums for the leasing software, because Tesla, since they will have the only software in the market, they could put a 20% premium on the price. And for the internal subscription price, I just made an increase by 2%, which is the targeted inflation. I think Tesla will be able to increase the monthly subscription cost higher. And the final big conservative assumption is a 30% cost of revenue. Considering this is purely software and maintaining software, 30% is high. And I think Tesla will probably be between 10 to 20%. If that's the case, then the revenue from this input will increase the share price of the potential valuation from full self-driving. For the percentage of revenues, I extrapolated cost of goods sold, depreciation, capex, and net working capital up until 2030. And this gives me the EBIT and EBITDA. And with these assumptions, I get the output. And using a 21% applicable tax rate for US corporations, a discount rate of 10%, a long-term perpetuity growth rate of 5%, I get the perpetuity approach equity value. And with an EBITDA multiple of 23 times, I get the EBITDA value of 2,230. And this is my DCF model until 2030, which will be in the description below. In conclusion, Tesla has proven its proof of concept. It has proven its ability to scale. It has a strong financial position. It has top-tier management. But Tesla has risks, but it has a high upside from a conservative DCF model. Especially if Tesla solves for full self-driving, it's able to scale to 10 million plus EV cars produced every year. If it can scale the energy business successfully, so check the risk and reward if they match your investment criteria. And again, as a disclaimer, this is not financial advice, but personally, Tesla at these levels is a bargain for a long-term portfolio of 5 to 10 years. If you reached the end of the video, you're awesome. And if you enjoyed, please like and subscribe as it will greatly help and support the channel. Have a good rest of your day, and I'll see you next time.